Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. The tech rally unravels. Markets plunge as a 5-day winning streak shatters, with investors fleeing tech. Are we witnessing the start of a brutal correction or a historic rotation into new sectors? Second, Fed under siege. A power play to silence the central bank and install a dovish chair rocks Washington, setting the stage for a historic battle over its independence. With markets betting on an 87% chance of a rate cut, is the Fed's independence already dead? And what does this political power play mean for your mortgage and the dollar? Finally, private credit bloodbath. Blue Owl's 20% loss proposal and redemption freeze traps investors, igniting a crisis in the red-hot multi-trillion-dollar market. Asset managers called it lighting the building on fire and locking the doors. As trillions in retail money pour into this market, is your investment sitting in a hidden trap? Warning, the markets just sent a clear danger signal. Technology stocks are starting to unravel as investors recalibrate risk ahead of crucial Fed decisions. The S&P 500 slipped 0.5%, breaking a 5-day winning streak, while the Dow Jones plunged 0.9%. Listen to me, this is not the time to hesitate. Decisive action is needed today. Why all the fuss? Investors are spooked by a cocktail of rising US Treasury yields, collapsing Bitcoin prices, and conflicting signals from the Federal Reserve. The Bank of Japan's hawkish stance on rates has sent a ripple through global markets, pushing US yields higher and squeezing tech stock valuations. With Bitcoin plummeting over 6% to below $86,000, it's clear that risk appetite is dwindling fast. Meanwhile, Fed Chair Jerome Powell's mixed messages on the likelihood of a rate cut on December 10 have left markets guessing. The FedWatch tool shows an 87 to 88% chance of a cut, but Powell's cautionary tone means nothing is set in stone. Let's break it down. First, the policy layer. The Federal Reserve's indecision is causing chaos. While markets are pricing in a December cut, Powell's latest comments suggest a pause is still possible if economic data shows resilience. Historically, whenever the Fed has vacillated like this, it's left markets jittery and prone to sharp corrections. The stakes are high with the upcoming December 5 jobs report set to be a game changer. A weak report will likely seal a rate cut and buoy markets, but a strong one could slam the brakes on the rally. Next, the money flow layer. Rising yields are spooking investors out of high growth, long duration equities. The 10-year Treasury yield has ticked up to 4.02%, reflecting the Bank of Japan's potential rate hike implications. This yield pressure is forcing a revaluation of tech stocks, which are highly sensitive to interest rate changes. The fear gauge, the VIX, ticked up as well, showing that nervousness is creeping in. Finally, the valuation layer. Tech giants like Apple, Microsoft, and Nvidia are under the microscope. The Magnificent Seven have driven much of the year's gains, but as their valuations come under scrutiny, we're seeing a rotation out of overbought tech and into undervalued sectors like financials and energy. These shifts are reminiscent of past cycles where overconcentration in tech led to abrupt sector rotations. Now, listen up. The strategy is clear. Cut your tech exposure immediately, especially in names like Meta and Microsoft, and rotate into financials and energy. Financials are a safe bet with rising rates boosting net interest margins, and energy is benefiting from geopolitical tensions pushing oil prices higher. This is your chance. Act now before it's too late. Sector watch, technology, XLK took a beating with a 1.06% decline. Broadcom AVGO fell 4.3% despite strong fundamentals, signaling profit taking. Meanwhile, energy, XLE, and financials, XLF, are ticking up slightly, riding on the back of a weaker dollar and strong earnings. If you're holding on to tech, consider trimming positions and reallocating to these sectors. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Short term, if the December 5 jobs report shows unemployment rising above 4.5%, double down on financials XLF and energy XLE. Medium term, assuming the Fed cuts rates on December 10, start accumulating quality tech names like Broadcom below $375, Nvidia below $520, and Microsoft below $480. Position sizing, reduce tech by 15 to 25%, increase financials by 5 to 8%, and energy by 3 to 5%. Advanced investors can hedge tech exposure with QQQ puts. Intermediate ones should consider inverse ETFs like SQQQ and basic investors increase cash holdings to buffer volatility. Time's ticking. Let's dive deep into today's critical market dynamics. The story begins with a statement that caught everyone by surprise. The man leading the search for the next Federal Reserve chair just went on record calling the constant speeches from Fed presidents redundant. Treasury Secretary Scott Bessent says it's time for the Fed to move back into the background and calm things down. This isn't just a personnel change. It's a potential power play to reshape the most influential financial institution on the planet. A while back, we flagged how mixed signals from regional presidents. Remember, New York Fed's John Williams hinting there was room for a further adjustment in the near term, were already amplifying volatility at a time when some key data were postponed. Today's push for a quieter Fed looks like a direct response to that communication sprawl. The constant stream of speeches from the 12 regional Fed presidents often creates a lot of noise and intraday market volatility. And here's the nuance. Only 5 of these presidents are actually voting members of the Federal Open Market Committee, or FOMC, at any given time. A move to a quiet Fed would be a major structural shift in how the central bank communicates, forcing markets to focus on official policy statements and hard economic data rather than trying to interpret a constant and sometimes conflicting play-by-play. As we discussed a while back, when unofficial trackers like Cleveland's inflation nowcasting start standing in for delayed official numbers, the credibility gap widens, so a quiet Fed only works if it truly channels attention back to the core vetted releases. And a new leader is coming. Prediction markets are giving National Economic Council Director Kevin Hassett a staggering 79% probability of being the next Fed chair. For those who are not familiar, prediction markets are platforms where people trade contracts based on future events, essentially betting on outcomes. So that 79% figure reflects a strong market consensus that Hassett is the leading candidate. Hassett himself is signaling a major shift, promising a Fed that helps Americans get cheaper car loans and easier access to mortgages at lower rates. Now, get this. When the market believes a dovish chair is coming, it starts to reprice assets immediately. This could accelerate a rally in duration-sensitive assets like long-term bonds and growth stocks even before the new chair takes office. This sets the stage for a major power struggle. The new chair will walk into a Fed that is deeply torn. The situation presents a fascinating duality. On one side, a faction wants to cut interest rates to protect jobs, while on the other, a group is worried that inflation still poses a major threat. Believe it or not, this internal division has a structural component. The FOMC's voting members rotate annually. A dovish new chair appointed now could find themselves clashing with a scheduled rotation of more hawkish or inflation-fighting regional presidents in 2026. This could lead to more dissenting votes and fractured policy guidance, making the Fed's future actions much harder for markets to predict. Continuing our last discussion, when easing signals were tentative and often contradicted by other presidents, the situation this time is different. Markets aren't just listening, they're pricing. The market is already placing its bets, with futures traders pricing in an 87.6% chance of a rate cut at the very next meeting. This highlights a deeper, more troubling issue: the potential erosion of central bank independence. When a Fed chair is selected based on an explicit preference for lower rates, it challenges the bedrock principle that the central bank should make decisions free from short-term political pressure. Historically, this has been a dangerous path. The tenure of Fed Chair Arthur Burns in the 1970s, who faced political pressure for easy money, led to runaway inflation. By comparison, Paul Volcker's independence in the 1980s allowed him to take the tough measures needed to crush inflation and restore economic stability. However, if you zoom out, you'll see another layer of strategy at play. This is about more than just interest rates. As Allianz Chief Economic Advisor Mohamed El-Erian put it, we don't need a play-by-play Fed. We desperately need reforms. The calls for change are coming from the highest levels, targeting the very structure and public voice of the central bank. For our audience in China, a Fed focused on domestic growth through lower rates could lead to a weaker US dollar. While this might ease some pressure on China's currency, a weaker dollar also acts as a form of trade policy. It makes US exports cheaper and imports from countries like China more expensive, which could complicate the broader trade relationship. The debate over who leads the Fed is becoming a battle for its soul. With a clear mandate from the administration to simplify monetary policy and a push to sideline the regional presidents, The next Fed chair isn't just taking a new job, they are being handed the keys to potentially overhaul a century-old institution. The path forward really hinges on the official White House announcement and the Senate confirmation process. Key indicators to monitor will be measures of long-term inflation expectations and the number of dissenting votes in future FOMC meetings. Speaking of the immense pressure on the Fed, let's shift our focus to a corner of the market where the promise of high yield is starting to show some serious cracks. It starts with a chilling quote from one investment advisor about the red-hot private credit market. They light the building on fire and then lock the doors and you're inside. And one firm, Blue Owl, just gave investors a live demonstration. The asset manager proposed a merger of two of its funds, a move that could have forced a staggering 20% loss on its retail investors. This is where the situation takes a more complex turn. Blue Owl then paused redemptions, effectively trapping investor cash until early next year. Here's where it gets interesting. These funds are often semi-liquid. This means they have built-in rules called redemption gates, which might cap withdrawals at, say, 5% of the fund's total assets per quarter. The goal is to prevent a bank run scenario, but when sentiment turns, these gates become the locked doors, trapping investors inside. The reaction was swift. Blue Owl's own stock plunged more than 10% in under 2 weeks as investors headed for the exits. The company then abruptly withdrew the merger proposal, only to announce it might reconsider it later, leaving investors in a state of chaos. But this isn't just about one company's fumble. Experts are sounding the alarm. As one credit director at the $90 billion firm DoubleLine put it, the only reason private credit offers higher yields is because it's packed with more risk from less stable companies. He warns, that doesn't sound like a trade that should be in a liquid fund. And this isn't just anecdotal, the data paints a grim picture. Recent reports show private credit default rates are already higher than those for publicly traded high-yield bonds. For example, one report from Fitch Ratings noted that defaults on US privately placed corporate debt jumped to 5.5% in the second quarter of 2025. This is the hidden risk that comes with the promise of high returns. This fiasco exposes a massive conflict. Asset managers are desperately chasing what analysts call hot money from retail investors, a market projected to explode from $1.15 trillion to over $6.2 trillion by 2030. Global private credit fundraising hit $59 billion in the first quarter of 2025 alone. But they are pouring this money into illiquid investments where you can't get it out quickly when things go wrong. This decision brings both the benefit of high potential returns for managers and comes with the inherent risk of trapping investors' money. Think of it like a bank promising daily withdrawals, but investing all its money in real estate that takes months to sell. When too many people want their money back at once, a situation we saw with a major Blackstone fund in late 2022, which also had to limit redemptions, the system can freeze. The Blue Owl saga isn't just a corporate blunder, it's a stark warning shot. As trillions of retail dollars flow into these complex funds, the promise of high yield is colliding with the reality of high risk, and investors are the ones getting caught in the fire. So what are the critical factors to watch now? First, you have interest rates. Many private credit loans have floating rates. So if the Federal Reserve starts cutting rates faster than expected, that attractive high yield will shrink. This could cause that hot money to suddenly reverse course, creating a major stress test. The second focal point is regulation. This Blue Owl incident puts a spotlight on the risks for everyday investors. We're already seeing regulators like the SEC push for more transparency, and an event like this could accelerate that trend. For global investors, including those in China, any instability in this massive multi-trillion-dollar market could create ripple effects, impacting everything from global stock markets to credit availability.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.